Welcome to today's Explainer. We're diving straight into the financial heartbeat of the Walt Disney Company. We're going to use their latest Q2 2026 earnings data, alongside a few market reports, to uncover the real story behind the numbers. It is a wildly fascinating time for Disney right now. I mean, they're navigating some major industry transitions, completely smashing box office records, and somehow turning massive streaming losses into serious profits. Let's get into it. Here's the roadmap for our analysis today. We're going to kick things off with a high-level financial snapshot, then unpack the incredible streaming turnaround, check in on parks and experiences, look at their recent box office dominance, address the linear TV anchor, and finally, wrap up with the future and shareholder value. All right, Part 1, the financial snapshot. Let's look at Disney's Q2 2026 baseline. So we're starting right at the top. Disney's stock is currently sitting at $99.39. This number is our baseline, right? It's basically the ultimate scorecard for how Wall Street is reacting to all the massive internal shifts happening across the company's vast portfolio of assets. When we check the vital signs, things are looking pretty robust. Total revenue up 7% year over year, supported by strength across multiple business lines. Segment operating income is also up 4%. Oh, and a quick side note, a 53rd fiscal week did provide about a 2% revenue bump. But what's really standing out here is management's absolute confidence. They're projecting a solid 12% adjusted earnings per share growth for fiscal 2026, and they're aiming for double-digit growth again in 2027. They are clearly feeling really good about their trajectory. Moving on to Part 2, the streaming turnaround. We're talking about a journey from massive losses to a billion-dollar profit engine. You know, this might just be one of the most dramatic financial turnarounds in recent entertainment history. Think back to fiscal 2022. Disney was bleeding cash in its direct-to-consumer segment, absorbing a staggering $4 billion loss. $4 billion! Fast forward to fiscal 2024, and they managed to squeeze out a $143 million profit. But then, look at fiscal 2025. Boom! A massive $1.3 billion profit. It's a total game changer, all driven by aggressive cost-cutting, strategic price hikes, and, cracking down on password sharing. So how exactly did they pull off that massive $1.3 billion? Let's look under the hood. Disney Plus currently boasts 131.6 million global paid subscribers, but the absolute magic number here is the ARPU, the average revenue per user. It hit $8.04, which is up nearly 12% year over year. A huge driver for this is their ad-supported tier, which now makes up roughly 30% of all subscribers. Advertisers are just eating this up, bringing in an estimated $2.86 billion in ad revenue for 2025 alone. Because of all this, management is now targeting an incredibly ambitious 10% operating margin for streaming in fiscal 2026. And this brings us to a literal watershed moment. CFO Hugh Johnston recently pointed out that they are now generating more revenue in streaming than in traditional linear TV. In fact, it was more than double in this most recent quarter. That means streaming isn't just some experimental future project anymore. It is, right now, the undisputed financial core of Disney's entertainment division. Which brings us to Part 3, parks and experiences. We're seeing record revenues, but amidst some noticeable attendance headwinds. We've got a real paradox on our hands here. In Q2 2026, domestic park attendance actually dipped by 1%, but and it's a huge but, the Disney Experiences division still managed to rake in a record $9.5 billion in revenue and $2.6 billion in operating income. So, how do you make more money with fewer people walking through the gates? Easy, a 5% increase in per capita spending. Basically, the guests who do show up are opening their wallets wider for tickets, food, merchandise, the whole shebang. Now, you might be wondering why the drop in attendance in the first place. Well, besides a dip in international visitors, Disney is explicitly pointing the finger at what they call epic-related headwinds. Yep, that's a direct, undeniable nod to the competition. Specifically, Universal opening their massive new Epic Universe theme park, which is definitely siphoning off some of that traditional Orlando tourist traffic. Disney is well aware of the pressure, but they're expecting attendance to bounce back once the hype of those competitive launches cools down a bit. And they definitely aren't just sitting around waiting for things to cool down either. Disney is fighting back with some massive global capacity expansions. We're talking a highly anticipated Villains Land and a Cars-themed area coming to Magic Kingdom, a Monsters, Inc. space at Hollywood Studios, plus the brand new Pueblo Esperanza in Animal Kingdom. On top of the theme parks,
They are aggressively expanding the Disney Cruise Line to a staggering 13 ships by 2031, including the recent launch of the Disney Adventure over in Asia. They are literally building out their empire to make sure they capture that future demand.
All right, let's pivot to part 4, box office dominance, specifically their rapid $2 billion start to 2026. $2 billion. That's a lot of zeros. Disney was the absolute first Hollywood studio to cross that $2 billion threshold in global ticket sales for 2026. And the crazy part? They did it before the big summer blockbuster season even kicked off. Just incredible momentum. So what exactly is drawing everyone to the theaters? It's a brilliantly executed multi-genre strategy. They aren't just relying on standard superhero fare right now. They dropped the massive legacy animated hit Zootopia 2, which alone raked in $1.9 billion globally, and, by the way, subsequently crushed 1 billion hours streamed once it hit Disney+. But then they also tapped into pure nostalgia with The Devil Wears Prada 2, clearing $552 million globally. Throw in Pixar's original film Hoppers and a super lean survival horror flick called Send Help, and you've got a wonderfully diversified, highly efficient slate driving those billions. But it's not all sunshine and fairy tales. Let's look at part 5, the linear TV anchor and the slow collapse of traditional networks. We have to be impartial and look at the risks, and the stark reality here is that legacy linear television is slowly decaying. Management themselves have openly admitted that their linear earnings base is just shrinking quarter after quarter. This whole cord-cutting reality creates some incredibly volatile situations. For example, a recent carriage dispute with Google's YouTube TV. Disney's networks went dark for just 2 weeks, and that little blackout cost the company an estimated $60 million in revenue. Poof, gone. It's a heavily shrinking base that Disney has to manage with kid gloves as they try to push everyone over to digital. And that leads us perfectly into our final segment, Part 6, the future and shareholder value, where we'll look at AI, capital allocation, and pull all of this together. So how is Disney synthesizing all these highs and lows to deliver actual value to shareholders? Well, Disney Experience's CEO Josh D'Amaro laid out a really clear 3-step roadmap. Number 1, creative storytelling is still the absolute core of the company. Number 2, Disney Plus is officially the ultimate digital centerpiece. It's not just a movie app anymore, it's a hub unifying streaming, live sports through ESPN, and massive interactive gaming via their partnership with Epic Games. And number 3, a huge acceleration in tech and AI. They're deploying AI to generate hyper-personalized content recommendations to keep you from canceling, dynamic ad targeting to pump up revenue, and even precision labor forecasting in the theme parks to run things as efficiently as possible. And what does this strategy mean for the bottom line today? Bob Iger recently announced that Disney is targeting a massive $7 billion share repurchase program for 2026. $7 billion. That literally doubles the buybacks they did in fiscal 2025. Plus, they are bumping up cash dividends by 50% to $1.50 per share. This aggressive capital return plan is a massive, flashing neon sign to Wall Street, showing management's utter confidence in their free cash flow and their newly minted streaming profits. Which brings us to the ultimate question I want to leave you with today. We've unpacked a lot, right? Streaming is finally a billion-dollar profit engine. The parks are extracting record revenue per guest, and there is $7 billion in buybacks rewarding investors as we speak. But can Disney's unstoppable digital and physical core entirely outpace the slow, undeniable death of their traditional television empire? It's a fascinating puzzle. Thanks so much for joining me on this explainer today, and as always, keep questioning the data.